managing member of Great Hill Capital. This is a long-short equity manager based in New York City. You've seen Tom plenty of times, I'm sure, on Fox Business and other networks. He has kindly wanted to stop.
I think it's us against them.
He's got a video cast, a podcast, and a lot of other ways on social media. You've seen him. Welcome, Tom, to the stage. We've got Louis Navalier over here. I don't know if you got a proper full introduction before, but let me just make sure we fix that. Louis Navalier, editor of Growth Investor, Breakthrough Stocks, Accelerating Profits, also founder and chairman of Navalier and Associates. And finally, we've got Michael Lee, founder of Michael Lee Strategy, an investment management and wealth planning firm. He's a 20-plus year veteran of the financial services industry. You see him on Fox Business as well. And I don't want to steal his thunder with some of the stocks he's talking about. I feel like him and Tom might have to go toe-to-toe a little bit. Welcome, gentlemen. Thank you. All right, so let's talk about this market. Let's talk about the big question starting with growth versus value. I think that, a lot of people, we had the Mag 7 market, we had a transition where it seemed like some of the other stuff was going to start doing better, and the recovery from this sort of, or this V-shaped recovery, we've seen a big Mag 7 resurgence. So I guess I'd start with what comes next, and since you're next, I'll start with you, Mike.
I think the market and the street as a whole has completely underestimated the size, the speed, and the scope of this AI trade. You can't capture exponential growth on a spreadsheet most of the time. This is the biggest technology trend ever. It's the fastest growing trend ever. I think it continues on, and we use opportunities and sell-offs to add positions.
I want to move to Tom because you gentlemen haven't been on the stage yet. Tom, what are your thoughts here? Value, growth, what's the best way to play this recovery we're seeing?
First quarter, we saw value outperform growth by 12%. Year to date, it's only 3%, so tech has made a comeback. I like to zoom out and take a longer term view. Since 1927, if you had invested in value over growth, you've outperformed by 4.4%. That's not over that period, that's per every single year. What does that mean in terms of excess returns? It means that $1 million you put in 1927, you got 68 million more by being invested in value over growth. Now, recency bias, the last 15 years, growth has outperformed value. Why? Growth always outperforms value when you have interest rates in the 1% to 2% range. When you're in 3% and above, value outperforms by 76% of the time. And in the years that value outperforms growth, on average, it's by 15% per year. So if you look at someone like Warren Buffett, who's outperformed the S&P 500 by double, basically 9%, over 6 decades, the reason is only 3% of his ideas made up most of the returns. What he did was he avoided the massive growth drawdowns, like the tech wreck, like the Nifty 50, like the growth manias, and by avoiding the mistakes is how he put himself in position to outperform. There was an article in the Wall Street Journal this week. If he didn't give so much money away, he would be $87 billion wealthier than Elon Musk, $400 billion from compounding money in boring companies consistently over time throughout cycles. So I have a view, and a little bit I'm going to tell you how I really feel.
Sure, we're going to get that. Is that guy retired? Do you have to follow him?
Yeah.
Just kidding about that, of course. John, why don't you just talk about your sort of view and approach in the markets here? It doesn't necessarily have to just be U.S. growth versus value. Just kind of curious.
Well, I'm very nervous to hear that somebody else actually likes value stocks. We don't like that. We like to be kind of left to ourselves. So hopefully it's just the two of us who do. But value is in the eye of the beholder. There are stocks that are trading at 20 times earnings that are value in our way of thinking. There are stocks that are trading at 6 times earnings that aren't value. So everything is about individual stocks as far as we go. And I'll have a talk later on, not to give you any commercial here, but since AI was mentioned, believe it or not, we do have exposure to AI as a value investor. We have a special report. If you come to my talk, you'll get it. And so I do think that value will have its day back in the sun. Obviously, it has had some so far this year. But as an investor, it's all about sleeping well at night as far as I'm concerned. And we slept very well during the turbulence that we had. Obviously, value held up much better than growth during the Liberation Day, post-Liberation Day events. So I think that for most investors who have accumulated wealth, part of it is preserving that capital and having the capital work for you, but not living with massive drawdowns and on the other side of the coin, hoping your stock goes up 37% in a day. So we really focus on buying what we think are quality companies trading at reasonable prices that, generally speaking, have dividend yields. And so our portfolios these days are yielding anywhere from 2.5% to over 3%, and our average PE for our portfolio is in the 14 range. So we think that there's lots of opportunity in this marketplace. Believe it or not, the average stock this year in the Russell 3000 is down 6%. Roughly, so there's still a long way to go just to get back to even for the average stock, and we think there's lots of opportunities for those who can pick and choose from amongst the rubble that's out there.
Got it. So let me move back to you. You were talking earlier about earnings growth. Obviously, that's a big part, I think, of your methodology. So tell me why you're focused on that part of the market and what an investor here needs to come to your side of the table for.
Well, I just go into earnings season locked and loaded all the time, and our average stock has over 20% sales growth. Earnings running about 58%, and earnings grow faster than sales for margin expansion. And we like to trade at reasonable multiples looking out a year. But so John mentioned the small cap arena. My small cap letter, trades at barely 6 times forecasted earnings. So you can have growth and low PE as well, but. Yeah. Basically, what happened is the earnings were better than expected. The guidance is improving. Obviously, the trade chaos never materialized. That 10% baseline tariff will be offset by an improving dollar, and the reciprocal tariffs. I guess they're sending out some letters next week. But if you are nice to the U.S. and have a surplus, you don't have a tariff like a reciprocal tariff like Britain doesn't have one. So Australia won't have one. So I think the tariffs will be absorbed. Meantime, they've dumped goods on America, and we have deflation. And I hope the Fed actually looks at the economic data for change and then starts to cut rates.
Mike, I want to talk about some of your stock ideas. You were in Sarasota, Palantir was the name you kind of focused on solely, and I remember Andy on the podcast, 4 weeks later, it's already up 50-some-odd%. So a big move in a short period of time, which is what you get with these kinds of stocks. But you also get the volatility, right? Should an investor worry about that? And if so, why? Or if not, why?
So a couple of things. So we'll touch on what Tom said about value versus growth. The pace, the speed of technology is increasing at an increasing rate. So it's just going to get faster, and the disparaging, in my opinion, between value and growth is just going to get wider and wider and wider. Also, a lot of the return that's now created in growth stocks happens in the private markets. So if you look at Google and Amazon from when they were started to how quickly they went public around the dot-com boom to your average tech company now, a lot of that return is sucked out pre-IPO. So one that I watched really closely, which I'm going to go in depth on, is CoreWeave. So CoreWeave did $200 million in revenue in 2023, and $1.8 billion last year. They're going to do $5 billion, $6 billion this year, 11, 12 billion next year, potentially 20 billion the year after. So you have 100 times revenue growth in 5 years off a $200 million base. Okay, there are no value stocks out there where you can create that, and you can't have all AI growth and tech stocks. But the reason why I'm so excited about growth in AI is because everyone's gun shy, right? Everyone's gun shy from the dot-com boom. Everyone's gun shy from the fact that value has underperformed for so long, and this volatility, and these companies seem to be trading at these astronomical multiples. Like that, to me, that perception that this can't be real, this isn't happening, it doesn't look like this in my spreadsheet, oh my gosh, how can I pay that type of multiple, just sets you up for people being short these names, for people not owning enough, for managers underperforming and chasing retail who believe these names and understand the story, which is just the exact opposite of almost my entire career, but I'm here for it and I love it.
I don't know. Should I call this growth versus Godot? I mean, if we're waiting that long for some performance, I don't know. No, I'm just messing around. Tom, I want to talk, again, just like in Sarasota and some of the other events where you made the case for some of these companies like a Boeing, for example, like an Etsy, that, had been beaten down. Why do you think that those are the kinds of names that are going to perform from here?
Well, look, I think Boeing has been a no-brainer. That's been a duopoly. That thing got down to $129 4 weeks ago. We went on Barney and we're pounding the table. It's $210 today, probably going to $250 over the next year and a half. I think people believe that it's an either-or decision. Either I'm a growth guy, either I'm a value guy. They're attached at the hip. And some of the best value stocks I've ever bought traded at PE multiples above 100. And you say, well, how the hell is that possible? Because they're in trough earnings cycle, and I play reversion to the mean. So earnings might be 2 cents a share, and then when they normalize to $5 a share, that multiple comes down to 8. So you have to have kind of a holistic view. Now, in terms of growth versus value, looking over 100 years, you look at a company by company basis. You have to say, okay, how much is priced in? Okay, how much of the good news is already priced in? And statistically, going back 100 years, you have to have the view, because so many people are trapped in recency bias of the last 15 years. Growth has crushed value. By the definition of how like MSCI defines it, not like necessarily how you invest in growth or how I invest in value, because there's like a lot of nuance to that. But in terms of cost of capital and what it takes to fund these growth ideas and these startups, and when capital becomes available, you saw the VC boom post-COVID when money was free. You saw the VC collapse in 2022. So I would just say price is what you pay, value is what you get. To take an all-in growth-only point of view in this environment with recency bias, well, that's what's worked for the last 15 years. You really need you must have an outlook that rates are going back down to 0 or 1% or maybe even 2%. And that might certainly happen, okay? But we're more in the camp of like 3 to 4.5%, and odds are 76% of the time we're going to outperform. Now, we're not just resting on our laurels, like buy a value ETF and hope for the best. I do a lot of turnarounds, which is different. When you buy Boeing when it's dislocated 66% and they operate in a duopoly, it's not a hard decision. You don't have to sit up at night and say, I wonder if Boeing is going to work. I mean, you could go to Airbus and wait 20 years for your next plane. I thought it was hysterical when the Chinese pulled their orders from Boeing over tariffs. The Chinese need Boeing planes like a diabetic needs insulin. I mean, it was just completely hysterical. It's like, okay, go to Airbus, wait 21 years. Oh, you can go to Comac. Good luck flying on those planes. They delivered 13 last year. You can't make this stuff up. So Mike and I think, agree on a lot more fronts than is apparent. And we also disagree on some. But I have growth stocks, as I define in terms of fast earnings growth. Maybe I'll pay a lower multiple. I believe in the technology story. I just look at what am I willing to pay for certain aspects of that story. And I have one of the cheapest, most incredible AI plays in the world at a very low price, which Mike might ask me, or you might have to stick around till tomorrow to find out.
I'll just interject. I don't like everyone's looking in the space that I'm looking at, that we're looking at growth because of the recency bias.
Yeah.
Which means if you're an individual stock picker in value, your opportunity for outsized returns is enormous. So with growth, you can really participate a lot passively. I think more actively, but in value, the difference between active and passive, I don't know if it's ever been this wide.
Yeah, I think that's a great way to frame it for sure.
And we're going to have absolutely time for stock picks, so get your pens ready, but I just want to cover one or two other sort of big picture things. First, John, the second part of this, U.S. versus international. I mean, do you even make that distinction? Or are you just looking for great fundamentals, whether it's traded here or based here or overseas?
The answer is yes to all those questions. And international markets, of course, have lagged considerably. And, I'm the guy who likes to buy the things that haven't performed, not chase the things that have. And so certainly having international equity exposure in your portfolio, I think, is a good idea. Obviously, international markets are up significantly this year, double digits, at least for the international strategy we run. But we're buying multinational companies that participate in international markets, and we're also buying ADRs, stocks that trade in the U.S. So we don't go into foreign markets per se, but we will buy foreign stocks as long as they trade in the U.S. So I do think international stocks should be part of an investment portfolio. And just to go back to this whole value versus growth debate, we all think that Warren Buffett is a value investor, right? Anybody think he's a value investor? Most people do, right? Well, he claims to be a value investor, but of course his biggest holding that made him the most money was what? Apple, right? Well, Geico, you can say Geico, but Apple, in terms of the things he's gone out and bought. Now, he was a little late to the party buying in 2016. We bought it in the year 2000. So my dividend yield on Apple, believe it or not, is 400% on my cost basis. So a value investor could have bought Apple at a good price. Buffett came along and bought it growth at a reasonable price. Of course, today Apple's not even really growing that much anymore. But this idea that it's either or, I think, is something that I appreciate the comment over there that it's all about granularity and stock picking. And I think that you just don't want to blindly go out and buy indexes, even though I understand they're more cheaper to buy. But I do think there is value, no pun intended, in stock picking.
Yeah.
So you talked a lot about sort of Trump's tariff strategy and some of the ramifications of that. How does that play into whether you're buying U.S. stocks versus international stocks at this point?
We have no bias. We'll buy the ADRs, but there's no doubt I found fewer ADRs in the post-Trump world. One would be VNet, which is cloud computing in China, because that DeepSeek was always crashing. Another would be HSAI, that's a LiDAR, for the self-driving the cars. All your cars that follow the other cars, which you actually need here in Miami, that's HSAI. But Trump put us on a bit of a roller coaster, but it's over. I was talking earlier, the negative press on Trump was emanating from the UK, and Yardeni did a great report that they had four negative economist headlines and said that's the time to buy because economists hated Trump. And I read Financial Times, they hate him. Yeah. But when he did the deal with Britain, the trade deal, now they hate Gersteimer, okay? Because they think Britain didn't get anything. Everybody's got a 10% baseline tariff. But what Starmer did is he agreed to open up the British markets to American beef and all that stuff. So they're all saying, why is he, going to put our farmers out of business and all that stuff, even though their beef tastes like crap. So, one kind of community service thing we should mention is Buffett came up, and everybody likes Warren, but Berkshire Hathaway trades at a premium based on its private businesses. Nebraska Furniture Mart, See's Candies, Borsheim's. And it's a little scary to think how much that premium might be. I used to remember being in the Cayman Islands 35 years ago. People were paying $1.32 to buy $1 of Soros, 32% premium. So they were actually doing that with Buffett because the premium on Berkshire Hathaway was pretty big with all those private businesses. So this performance has been exasperated by that premium. Now, I don't know what those private businesses are worth. I do know Plano, Texas, and Nebraska Furniture Mart exit is two exits and 31 football fields. So these are real businesses, but just the way he structured his business, people were paying a premium for it. And so that's a little scary that when he's gone, what's going to happen? Of course, their earnings just fell 2/3 because they're mostly reinsurance and they had to pay for the LA fires.
Now, I want to probably give each of you guys have each mentioned some names already, but I want to kind of maybe give you a chance to talk about your two favorite picks, a minute or two total, just that way we can leave some time at the end for questions. Since I started over here, John, I'm going to start with you down at the end. If you weren't ready, I'm throwing it at you.
No, two favorite picks. I have 100 favorite picks. For us, it's all about broad diversification. But in our latest newsletter, which you'll get as well if you come to my talk this afternoon, we recommended UPS, which of course is the shipping company, and Merck. Those are two names. And the reason we like them is they're trading at single-digit PE ratios. They're quality businesses in our mind that deserve to trade for higher. valuations. Merck is the U.S. Merck, not the German Merck. MRK and UPS are the ticker symbols, but you get big dividend yields with them as well. And again, for us, it's all about total return. Total return is capital appreciation plus the income you receive from dividends. And again, it's all about sleeping well at night. And I prefer to put my money into businesses that I think are going to be around for the long haul and that are trading at very reasonable prices today and rewarding me with nice dividends. And oh, by the way, have not performed all that well. In fact, they performed poorly, really bad. And so I want to buy things that have gone on sale. Buy low and sell high is the idea. And I think those are two names that are attractive.
Thank you. Tom, I know we kind of already talked about one, so I guess besides Boeing, what else do you do with your top names?
Yeah, I like two names that I've actually presented at the Money Show that are up a lot since then. One was Alibaba, so that gets two things going. So to bet on international, you have to believe that the trend of the dollar in the intermediate term is going lower. If you look at the cycles for the last 40 years, it looks a lot like value. If you overlay value growth relative to interest rates, it's a pretty regular cycle. If you overlay international versus US, relative to weak dollar is stronger international. So this gets value and international in one package, Alibaba. It is the cheapest way to play AI in the world, trading at 13 times forward earnings. Earnings are underestimated at 12, 13 times next year. They have the fastest models against DeepSeek, against OpenAI. That recent data came out this week. They also have a piece of effectively every single AI startup in China, because they come to them and they say, we need compute power. They're the leader in the cloud business. And they say, no problem, we'll give it to you for free. Oh, by the way, you're going to give us equity in your business. So there are a lot of thousand baggers in that equity that's not even priced into the stock. Taobao and Tmall, they are a toll taker on the Chinese middle class. They've been pumping stimulus for the last 9 months. They're going to do more now that the tariff thing is over. Revenues were up 12% year on year. This is a monster business. 40% of Chinese e-commerce goes through Alibaba. It's a leverage play on that recovery. Their international is growing at 20%. They've got 60 some odd billion dollars in net cash. They bought 5% of the float in the last 12 months. So that's one I like. And then there's one that I talked about on this stage. Then when it was, we initiated our position at $5. I think we talked about it on stage at $7 or $8. It's called Cooper Standard. This is an auto supply company. They do the rubber ceilings around the doors and windows. And they do fluid transfer systems. It is a leverage play on the recovery of U.S. auto SAR. Trump has in the tax bill, he's going to try to make interest rates, car loans tax deductible. Whether that goes through or not, the average car on the road is 13.5 years. You don't want to play the warring factions, GM and Ford, because it's going to be a race to the bottom in terms of incentives and volumes, in terms of margin compression. You want to play the arms dealers, the auto parts suppliers that have been left for dead in the last 2 years when SAR got down to 15.2. This has been a five-bagger for us. We think it's going to double again from here, and probably more than that if they get up to normalized $7 a share of earnings, which they did at the last SAR peak in 2017. So those are my two picks. If you had come to past money shows, you've made a lot of money. Boeing's up 60% year to date, give or take, and it's going a lot higher. So that's what we like. And by the way, to speak about Buffett, yes, Apple has done a huge amount of his returns, but his entry point in 2016, it was trading about 14 times earnings, and he benefited from multiple expansion, buybacks, and all that stuff. So he bought a great quality business at a reasonable price, and that's where we agree. It's like price relative to earnings growth, I just think it's a very exciting time right now to be in equity markets and to participate, because I think Trump is right. He was right about the bottom of the market on April 9th when he put out that tweet, now's the time to buy stocks. And I think he was right last week when he said America's going to boom.
I should have asked you this, John, actually, but Baba, BABA, Cooper, what's the ticker again?
CPS, Cooper's.
Do you have anything else? The earlier stocks that you mentioned before I get to you, Mike, wasn't CrowdStrike.
CoreWeave.
CoreWeave, what was the ticker there?
CRWV.
Let me put a caveat on Baba. We've switched all of our Baba holdings into Hong Kong holdings. So if you have like Interactive Brokers, you can call your brokerage and just swap them out. It's an 8-to-1 exchange rate because the currency rate is fixed. That's a hedge because they were throwing that out there in the negotiations with China, the delisting. They already went through the PCAOB 2 years ago. But as a fiduciary, just to manage that risk, why take the risk if you don't have to? We own it in Hong Kong under ticker 9988. We do have a bunch of US derivatives, which we're just willing to assume that quote unquote delisting risk. I'd assign maybe less than 15% probability, but it's not nothing. Rick Scott is kind of interested in that, and the new SEC chair is interested in that. The only one that would torch if they do that, and it's not politically feasible, if they delist it, they torch $800 billion of U.S. investor capital. The Chinese don't care. They'd be laughing all the way to the bank. It's like, we don't own U.S. ADRs, so have at it.
Yeah. So, yeah, about a minute or so, we'll be here.
Well, our top two holdings are Lilly, which would be Novo Nordisk at its own drug game, and they've just fired the Novo Nordisk guy today. Novo Nordisk gave a lot of their business to him and hers because they were doing the compound GLP-1s, which you can't do. So we do have Lilly, him and hers. Our largest holding is NVIDIA. It's like 20% of some of our accounts, 300%. Supermicro's big, but we got AppLoving, we got Plantair, we got a lot of good stocks, and but we are overbought here.
So CoreWeave, which I'll go into in my presentation this afternoon, a lot of that. I love Palantir. It's probably better to buy it a little bit cheaper than where it is right here, but if you have a $60 billion AI software market this year, it's going to be $1 trillion in 2030. Palantir keeps that same 7-8% market share. You're looking at $4.5 billion to 70-80 in 5 years at like 70+% margins, like things you can't even imagine. So, and then like all the hyperscalers, like NVIDIA's down year over year, which is just mind-boggling. And the only thing holding NVIDIA back is the ability for Taiwan semi to scale up. You can't solve for lack of demand. You can create engineering solutions to increase supply, and so that's what we're in the middle of. So AMD, Marvel, Broadcom, NVIDIA. It is boomtown for all these names. The street doesn't get it; they're gun shy. If you can not convert into a Panakin during the tariff wars, you could make yourself an incredible amount of money over the next few years.
I'm going to just mention it briefly, and then maybe we have 1 or 2 questions. Mike Lee is going to be at 3:40 in the Brickell North room. So again, if you don't get a question asked here, you'll have a chance to do that. John will also be there in Brickell South at the same time. So depending what you heard here, if you want to see one of their presentations, you can. And Tom is going to be back up here on the main stage tomorrow at 12:15. So he's going to give you some more picks and ideas, and also why he goes with the nickname Turnaround Tom. With that, I do want to again have a question or two. Get to that before we move on. Oh, that's easy. Nice short walk.
What about macro risks like black swan events, for example, Taiwan being invaded by China? Like, how do you factor that into your thinking?
That's not going to happen. So when China takes over, they like to do it politically. That's what they did in Hong Kong. They were granted Hong Kong, but they took it over solely politically. Even though they had protests, everybody hiding in stores. So when they had the election in Taiwan, they were trying to get their guy in, and they didn't. But they'll try to do it politically versus militarily. Xi's been firing a lot of his generals and things like that. Your biggest black swan risk is leverage debt, private credit. So I'm up in Palm Beach, and in 2008, everybody was bragging to me that I'm earning 13 to 16% a year tax free, and they were buying leveraged muni products, these hedge funds. And they were leveraged usually 6 to 1. So I was curious. I went to one of the presentations. I went to the Citibank one. And a guy named Jack Lew did the presentation. Anyway, very impressive presentation. Jack was an impressive fellow. But then when the credit default swaps broke, they had to unwind all these leveraged muni products. And when Wall Street sees you coming, they dropped the bid. And so they lost 97% of their money in A-rated munis. Because there was a brief period of liquidity. And then Jack Lew lost his job. And he got another job. Does anybody know what his job was, Jack Lew? He became our Treasury Secretary after he scammed senior citizens in South Florida. So that's how when you see him on TV, that news channel is fake. So now they're leveraging debt again. It's only 2 to 1. It's in private credit. It's it was 10 years ago, it was 438 billion RNG, and we now it's 2 trillion headed to 3 trillion. It's just overpowered all the Morgan Stanleys and the Merrill Lynches, and you know, they say, oh, I got a window, you want to get in? You get in. What can I get? I'm not sure. You know what I mean? And they're leveraging debt to get you those yields, and eventually it will break, okay? And that will be your next black swan event. So we can grow the economy, we probably won't have it, but if it's pretty scary when you think about it.
Yeah, I would just add one thing. There's the massive trend, the parabolic move, is in no mark to market. So why this has all grown so much, whether private equity, whether private credit, is because the pensions can come in and they all get to keep their jobs, because in stocks, it goes like this, but it trends up if you got the right stocks. With private credit, you get no marks until you get one mark down to zero. And they collect fees holding it up to this level, even if there's deterioration under the surface. So I kind of like to have mark to markets, because then you can see problems before they show up, before you get the full mark to market and you're out. So I agree with Louis. If I had to think about something that would worry me, that would be the pocket that would be of concern.
So leverage loans are running about a 7.2% default rate now. So I don't know how high they have to get up before they take private credit out, because they're all a little different. But that's what's going to happen one day.
All right. One quick question. If not, otherwise, like I said, 3 of the 4 gentlemen up here, you have a chance to ask them those questions in the presentation. Okay, well, excellent. Then thank you so much.
Nice to meet you too. Nice to meet you.
I told you anyhow.
I like your UPS call.